Good afternoon, and welcome to the Energy Perspectives Group webinar hosted by Journey Energy, Inc. This event is being recorded. During the presentation, all participants will be muted. If you have any questions you would like to ask, please type them into the chat feature. We will read and answer questions at the end of the presentation. Thank you so much for joining us today. Now here's Dan Steffens, who will introduce today's speaker.
Hi, everybody. Welcome to today's webinar that is being hosted by Journey Energy. That trades on the TSX exchange with the symbol JOY. That's easy to remember, JOY. And on the US OTCQX with the symbol JRNGF. Joining me today is Alex Verge, the company's president and CEO. Journey Energy was founded in 2007. It's headquartered in Calgary. It is involved in the exploration, development, and production of crude oil and natural gas in Alberta. The company was formerly known as Sword Energy and changed its name to Journey Energy in July 2012. Today, Journey Energy is a publicly traded oil-weighted exploration and production company focused on creating sustainable value through the responsible development, enhancement, and continued growth of their low-decline asset base situated across Alberta. It also has a power business that should go free cash flow positive in 2025. Journey's operating expertise lies in pursuing growth through drilling on existing core lands in Alberta, implementing water flood projects, and they have an active polymer flood project, completing accretive acquisitions, and growing their overall production and proved and possible reserve base. The company seeks to optimize production from its legacy oil pools by applying best practices for horizontal drilling and completions with techniques, and where applicable, using water floods to enhance production volumes and its reserve recovery. The company recently announced a Duvernay joint venture that has significant size and potential for a company of this size. Today's speaker is Alex Verge, Journey Energy's president and CEO. Alex has more than 40 years experience in the oil and gas industry. He has served as director, CEO, and president of New Vista Energy and is a member of the Association of Professional Engineers, Geoscientists of Alberta. He received a bachelor's in science degree in chemical engineering from the University of Toronto and a master's of engineering degree in chemical and petroleum engineering from the University of Calgary. So during the webinar, if you have any questions, please type them into the chat box and we will answer them after the presentation. With that, I will now turn it over to Alex for an update on Journey Energy's accomplishments in 2023 and their business strategy for 2024. So take it away, Alex.
Thanks very much, Dan. And thank you, Energy Prospects Group, for hosting this webinar and allowing us to tell our story. As Dan mentioned, we've been around for a really long time and had quite a history. I didn't start with the company in 2007. I started around 2010 as a board member for the company in late 2010, early 2011. And then in the spring of 2012, took over the company as a private company. Then we took the company public in 2014, more or less at the peak of the market. The company, there's a series of kind of timeframes in order to look at the company and to understand the history of the company. But I'll gloss over very quickly the initial history of the company. Like I say, we went public in 2014 at the peak of the market. At the time, oil had been over $100 for 5 years. We had a $220 million bank line, basically right after we went public, the market kind of deteriorated for oil and gas stories, and we all know what happened between essentially 2014 and 2020. And so our bank line subsequently got cut. We ran into a lot of issues in 2020. Our bank line got cut gradually from 220 million down to 90 million and then down to 75 million. And then in the middle of COVID, it got cut completely. So the stock went from $12 at the IPO to an absolute low of about 6 cents in the middle of 2020. So pretty stressful time for us, and we've recovered from it. And because of that recovery and the way we recovered from it, I think there's been a lot of positives for the shareholders, and there's been a real positive in the way we look at the company and the way we're trying to set the company up for future. Obviously, safety and protection of your investment is the number one goal that the company is striving for since 2020, since we got into those issues. So since 2020, we restructured our bank debt at the end of 2020. It's pretty much a one-off where we used second lien capital from Aimco, who is our largest shareholder and was pretty much our second lien debt holder at the time, to buy out the banks at a discount, and most of that discount was passed on to the common shareholders of Journey. So the company moved forward out of 2020. We replaced most of our production without drilling a lot of wells, just because we have a very long life reserve base with a very slow corporate decline. So our corporate history was such that we were able to advance some of these pools in 2020 and late 2020, but 2021 and 2022. By mid 2022, we had our balance sheet in very good shape. Then we wound up doing a large acquisition. So I'll talk a little bit about the large acquisition. I'll give you a little bit of a chance to know how we think. But the things that I want to leave you with today, the theme of our presentation is unbridled. So what I want to leave you with today is that the company itself is extremely stable. We have a low decline, predictable asset base, and we're doing a power business. The power business is not a complete diversion from what our base business is to grow our oil and gas production, but what it does do is it offsets our largest cost. So we'll talk a little bit about that, and it's a great piece of business for the company. Our balance sheet is now in tremendous shape. By the end of the year, almost all of our remaining debt will be termed out to 2029, so no principal payments next year. And there's a very compelling value proposition with respect to where we trade. So, you know, very safe, very stable base, but we also have some of the things that are common in the companies that are currently being revalued in the marketplace. And that's this emerging power business, which differentiates us, this Duvernay resource development. And as a company, we have a really great track record of doing accretive acquisitions. So a snapshot of where we are today: we're producing about 12,000 barrels a day. We are liquid weighted. About 75 to 80% of our revenue comes from liquids. We are 55% liquids. We do have this strategic relationship with Aimco, who is our largest shareholder. And we have a little bit of debt with Aimco, which we're slowly whittling away now between the end of the year and the first quarter of next year. And Aimco will go forward as a large shareholder of the company from that point forward. We have a very low corporate decline. And one of the things I want to draw your attention to, obviously, we throughout the years, we've had a lot of restructurings, but in that we've made a strong effort to preserve all of our tax pools. So we have over 675 million in tax pools. We are non-taxable over the medium term here. And we do have a $51 million capital program this year. One of the things that I want to highlight is only a small portion of that capital program this year is actually growing to grow our volumes. We're spending money on our power business. We're spending money on polymer flooding and water flood and facilities upgrades, which are going to go to the future decline, reducing the future declines, but don't add current production. So that's one of the differences between where we are today and where we're going in 2025, is that in 2025, we've got a wall of free cash flow coming at us that is going to be able to help us grow our business again. And I'll explain to you how we've got that. So I'm not going to spend a ton of time on this acquisition that we did. What I will tell you is that we announced this acquisition in July of 2022. The really interesting thing is we only issued about 3 million shares of Journey to pay for a $140 million acquisition. We did most of it with debt. All of that debt was in friendly hands. In other words, we pushed out some Aimco debt obligations, and then we also took a vendor take back from Enerplus, the company we bought the assets for. So by the time we closed this $140 million acquisition, which was effective May 1st of 2022, we only had to pay $115 million for it because the asset itself had cash flow $25 million. Then we did a vendor take back note with Enerplus, and that vendor take back note had principal payments on a monthly basis, but those principal payments were tied to the price of WTI. So as WTI deteriorated moving into 2023, so did our principal payments. We finally finished this off in March of this year. But the long story short is that acquisition paid for all of that through its cash flow over the years. So we closed this acquisition for $115 million in October of 2022. November, December of 2022, all of 2023, this asset produced positive cash flow. So we're probably about $90 million into it. And by the end of last year, the properties alone were worth $173 million. And that's just on the PDP. There's also an upside wedge in that. Most of that upside wedge is in the key property that we purchased. That was the Med Hat property. And this Med Hat property is a very large, there's over 300 million barrels in place, oil pool. And it has recovered about 12% or 13% of the oil to date. We have flooded only about 70 of those 300 million barrels with polymer flood. And so part of the upside in the future is to expand that polymer flood throughout the remainder of this field. We're going to start expanding it this year, and we'll continue expanding it year over year over year. Right now, we don't have any of that expansion really booked in the development wedge of this property. What we do have booked is about 30 locations in that property, and those 30 locations, you can see the darker green on this chart in the bottom right-hand corner. That darker green is some wells that we've just drilled. We've just drilled 8 wells, 4 in the fourth quarter of last year, 4 in the first quarter of this year, and that's the start of that kind of 30 well development program in this field. And you can see that we've proven the concept and we've proven how effective it's going to be. So that development wedge alone in Med Hat, without even the polymer, is worth close to $1 a share in upside value inside the company. So I'll talk a little bit about our business plan. For 2024, our guidance is to produce about 11,500 to 12,000 barrels a day. Cash flow is about $70 to $73 million. We exited last year with $61 million of debt. That's where we're sitting right about now. If you look at it, $61 million of debt versus $70 million of cash flow, not a lot of debt. You'd ask yourself, okay, well, this guy's balance sheet is in really good shape. Why do they need to do anything? We wound up doing a convertible debenture in March of this year. And the reason we did that is not because we had too much debt, but largely because all of our debt was due in the near term through the Enerplus vendor takeback and through the Aimco payments that we had pushed further into the future. So we did this convertible debenture. So at the end of the year, we're going to have 40 to 44 million of net debt. And that convertible debenture represents about 38 million of that. And that convertible debenture was done in March 20th of this year. It has a 10.25% interest. It was done by 3 parties. And the conversion price is about $5 a share. So stock's trading at about $3.20 right now. So $5 a share is a significant premium to the $3.20, but it's actually fairly close to our proven developed producing value right now today. So with that, it's a big step change, because if you look at our business plan, you'll see that we paid down at the end of 2022 with the acquisition. Our net debt had climbed back up to close to $100 million at the end of the year. We paid off about 40 million of that in 2023. We're paying off about 20 million of that in 2024. We don't have to pay any of that in 2025. So that's an additional 20 million of capital that is going to go into the ground here. We have a sensitivity chart in our presentation. We are very sensitive to the price of oil. So I'll talk about this power business. It's not a diversion for Journey. It's just a complement to what we're already doing. We started it with our first small power project down in Kaunas in 2020. That cost us about $7 million. We've been burning gas and selling power to the grid since then. That project has more than paid for itself right now. on average, for the first 9 months of 2023, it was equivalent of selling gas to the grid at about $9.47 an MCF. So that's what's happening here, is that you're basically converting gas to power and selling that power to the grid. And we're doing that. When we saw that, we said, okay, well, let's do more of it. And then we decided to build a power project in the Gilby area of Alberta, where we have another gas field. That's a 15 megawatt project. It's currently on production, under construction. We're estimating that it'll be on stream close to October, sometime between October and the end of the year. Again, that project is going to cost us about $21 million to complete. We've got about $12 million in the budget this year to complete it. We've already spent some of it on it already. That brings us to the one below it, Mazeppa. That's a project that we didn't really have any plans for it, but what happened is a company built this project for $31 million. It ran about 7 years ago for a period of about 9 months and then was shut in. What happened is the AER shut in the company that owned this project, started dismantling their facilities because they weren't paying their deposits on their wells. Long story short, this sat there for a while, and then the AER put it up for bids. It was a running project. We were able to buy it for $5 million, even though it cost $31 million to build it. It might cost more than that to build it today. So we have, since November of 2022, we have been in the approval process to activate this in place. We passed through the high level approvals. We went into the detailed studies starting in September of last year. We're hoping by late June of this year to get the results on when this can come on and what we need to do to bring it on. But we're highly confident that we'll be able to bring it on sometimes towards the end of this year in the current location that it's at. So with Gilby and Mazeppa, we've got about $17 million of this year's capital budget dedicated to getting those two projects back on. Combined costs for both of those projects will be about $30 to $35 million. The cash flow from these three businesses will be about $15 million a year. And when on stream, the present value of these projects is forecast to be about $90 million. So when I start talking about PDP values, virtually none of that $90 million is in that value proposition. So the reason we're doing it is shown in this chart. Long story short, I'll just say that the red line on this chart to the left-hand side of the dashed line, that is the actual fuel and power costs that we paid as a company, monthly fuel and power costs since 2021. The dashed line left on the left-hand side of the vertical dashed line on this chart, a mustard colored dashed line, is hypothetical, but that's if all of these projects were on January of 2021, how much revenue would we have made from these projects if they were on? So what you can see is that there's a lot of volatility in power prices. There's a lot of volatility in the system, but you can see that in general, over that period of time, the revenues that we would have received from these more or less offsets the fuel and power costs that we're actually paying. So when you look at the forecast in the reserve report moving forward from 2024 and beyond, the mustard colored solid line is our projected fuel and power revenue from these power projects moving forward. That's what the $90 million PDP value is based, or the PV value is based on. And the red line is the fuel and power costs that are forecasted in our reserve report moving forward. So we're doing this because we consume a lot of power. A lot of our projects under secondary recovery, there's a lot of water being cycled. We consume a lot of power, so we're offsetting our power. This is about 25% of our operating costs moving forward, and we're offsetting them with this revenue stream. So we've done a lot of things over 2023 and 2024 to position the company for 2025. And, you know, some of those key things is we've invested significant capital in these power projects. So these power projects, by the end of this year, we'll have spent $30 million on them, but they'll be cash flowing $15 million a year starting in 2025. So in 2024, we spent 17 million to bring them on. In 2025, we not only don't have to spend that 17 million, but they generate 15 million in revenue. So when I say that this year we're going to cash flow 70 to 75 million dollars, we can add 15 million of revenue to that and say next year we're going to cash flow 85 to 90 million if prices stay exactly the same. And with that, we're not going to be spending on power projects, and we're not going to be repaying the principal portion of our debt because all of our debt's basically going to be termed out. So that's going to free up about 50 million of incremental cash flow to grow our business next year. And so what are we going to do with some of that incremental cash flow? And that's a play that we announced on May 7th of this year, and that's with Spartan Delta. It's a joint venture in the Duvernay. We were an early mover in the Duvernay. We'd accumulated lands pre-COVID. We had farmed them out. That led to the drilling of 3 basin leading wells. They're shown on this chart, the 6 of 28 discovery well, and then the other solid well to the southwest of that. What you see in the dashed line on this chart is the joint venture area. It contains about 128 sections of land. What you can also see in the green shaded in area is what we have mapped as the sweet spot of this play. And that's the area where it's oil rich. So our play is forecast to be about 74 to 75% liquids moving forward. The initial joint venture is 37.5% Journey with lands that we accumulated in 2023 and 62.5% Spartan Delta. So we accumulated about 34 net sections of land. And the key for us was that we didn't want to farm down that interest. We had a lot of players in the area that were interested in our land, that wanted to farm in on it or buy it. And we said, no, we would like to participate in this project, but we don't want to reduce our net sections. So the answer to this was basically to say, we'll pool our land block with your land block, and we'll pool it so that all of the lands are going to be in the sweet spot, and we will drill wells at a slightly lower working interest. So that's why we're 37.5% in this, but we still have essentially 34 net sections of land. And when you look at the amount of land that Journey has in this play, we have enough land to support about 60 net 2-mile locations, which are similar to those 3 locations that are producing on our land block that are shown there in this slide. Those 3 locations, the production is in the right-hand side. Those wells have produced over 200,000 barrels each, or close to that. They've been on for an extended period of time. You can see a black line on that chart to the right. The black line is the type curve that we're using. That type curve generates the parameters that you can see in the top right-hand side of this chart. These wells are costing $11 to $13 million each. They have present values in the neighborhood of $7.5 to $9.5 million. Rates of return in the 30 to 50% range. And essentially they come on at close to 700 barrels a day and produce about 570,000 barrels of reserves. Like I say, 74% of that is oil and light oil. So if you look at 60 net locations and potentially $8 million a location, you can see how significant that is to the company moving forward. So now I'll just move really quickly as I finish up here to the value proposition inside the company. I mentioned that key property that we acquired in Medicine Hat. That property alone, if you include the development wedge, is worth close to $170 million. I mentioned our power business. That's worth $90 million. The value of those 2 things alone exceeds the enterprise value of the company on April 1st of 2024 at $258 million. So that means you get the other 10,000 barrels and the Duvernay and everything else free, including our development wedge. So there is an extremely compelling value proposition, and that's why we're out here trying to tell the story now, because the company has never been better situated. It's never been safer. It's never been able to provide investors with the kind of upside that it has in front of it right now. This just to show that the pricing that's used in our reserve report to determine these values is, in my view, fairly conservative relative to the current prices that we're currently receiving. Here's the PDP value of the company. It came off a little bit because prices were pretty high at the end of 2022 based on a really aggressive pricing in the middle of 2022. As that pricing came off, the PDP value came off a little bit, but you can see that we still have very high PDP value relative to where we're trading in terms of shares April 1st at 325, which is about where we are today. So you're buying the company for less than the PDP value of the shares. You've got a huge upside wedge. That upside wedge doesn't even include any value for the Duvernay. We have no Duvernay wells or no Duvernay upside booked in our reserve report. The reason for the compelling valuation, in my view, is summarized in this slide, where Journey has a very low decline. Basically, top decile in terms of the decline moving forward. So you tend to have a long life, very flat revenue stream. So our PDP value on our reserve report is about 5 times our cash flow. If you have a steeply declining company, you may have a PDP value which is only 2 times cash flow. So because we have a really long, stable cash flow stream, we have a very low value to our developed producing value. So it represents a very compelling. Companies generally traded about 3.5 times cash flow. For 3.5 times cash flow, if you got a big decline, well, you know, that's more than your PDP. 3.5 times cash flow, if you've got a basin leading decline, is well below your PDP. And that's where we're sitting today. I won't cover that in the interest of time, but I'll tell you a little bit about our conventional development wedge outside of the Duvernay. We have about $250 million in capital projects booked in our reserve report. We have only about 40% of our projects booked. We have even more projects that are unbooked in our reserve report. You can see that we have a variety of different things, from water floods to horizontal multi-stage oil drilling to gas-weighted drilling. Our projects in the reserve report generate rates of return that are extremely attractive. For every dollar of future capital we spend, we generate about $1.20 of net present value in reserves. That's very competitive with many of our peers. The rates of return are very high. Our F&D costs in our reserve report are in the $8 to $9 a barrel range. It's quite consistent with the dollar per BOED cost that we have booked over the last 3 years in the company. If you look at our historic F&D costs, they're in around the $10 a barrel range. So very consistent with what we've got booked in our reserve report, and about 20,000 a BOED, which is also very consistent with what we have in our reserve report. We have over 1 billion barrels of oil in place. When all's said and done, we've recovered about 12% of that already. We may recover up to 15% of that. If we could just add a little bit more to that, we can double or triple our reserves on our conventional properties alone. So that was pretty much what I wanted to highlight at an extremely high level here. I wanted to leave ourselves lots of time for questions, but the summary here is that, you know, we're paying off about 20 million of our debt this year. That's going to leave us with debt levels in and around $40 million at the end of the year. We have a $38 million convertible debenture. That may or may not be debt. If all of a sudden the stock trades above 6.25 a share, we will force conversion of that, and that'll become equity. That being said, if we look at it as debt, that debt is less than 50% of cash flow for next year, and that debt is termed out for a period of till 2029. So we don't have to make any further principal payments. So we paid 20 million off this year. We don't have to pay that off next year. We put 17 million in our power business next year, this year. Next year, that cash flows 15 million. So, and like I say, that $90 million in power value will all be realized once both those projects are are on, and that will be moving from our 2P category to our PDP category. We're hoping to begin the development on our Duvernay sometime this summer. We've approved about $30 million of expenditures in the Duvernay in 2024. We had announced an increase to our capital budget on the 28th of March of this year. That $10 million increase will largely be the money that funds this Duvernay. These wells should be drilled probably August, September, hopefully come on in the November timeframe. So by the end of the year, you have the catalyst of the Duvernay, you have the catalyst of these power projects coming on, more clarity on when Mazeppa is going to come on. And, you know, we are positioned for dramatic growth here in 2025. So, you know, we have lots of time here. I'd love to open it up for questions.
Okay, good job, Alex. First of all, let me kind of summarize what I see, and this is what I look for. And my job is to find companies like this that are grossly undervalued by the market. And in looking at it, I think your stock is trading below book value. Is that not correct?
100%.
So you got a stock trading below book value at a deep discount to the PV10 value of its proven reserves based on last year's reserve report, on the 2023 reserve report. And then when you look at what the program is this year, you're spending money this year to set up much stronger cash flow next year. So once you get this, you know, this year's cash flow, 20 million is going to go to pay off that outstanding term debt. And then after that, you're pretty much have no debt payments. You just have interest payments. But with all that next cash flow, there's a lot of upside for putting it back in the ground or paying dividends or whatever next year, but growing the asset base. And so I think it looks really good. But so no debt problems, lots of running room in existing assets. The Duvernay joint venture, absolutely, I can see the significant potential of that deal for a company your size. And I like the power thing. I like the power deal. You know, we have so many companies out there that are Permian Basin companies, and they're basically giving their gas away. And I hope this thing spreads. I hope this idea spreads, that more of these companies start generating their own power instead of just giving their gas away and then paying, you know, high prices for other electricity, which is kind of stupid. But anyway, okay, a few questions I have, and I need this kind of information for modeling, but what's the current production mix between gas, NGLs, and crude oil?
Yeah, the current production mix, like I say, we're close to 12,000 barrels a day in the first quarter. Of that mix, your oil production is about 5,500 barrels a day or 5,600 barrels a day. And of that, I would say about 2,200 of that would be WCS based, and then the rest of that would be kind of more of an Edmonton Light or MSW based. And then we produce about 1,200 barrels a day of NGLs.
Okay, 1,200 oil, 5,500, and the rest
and about
gas.
30 million a day or 31 million a day of natural gas.
Okay, what are NGL prices running, and are you seeing them kind of tick up because they are down here now?
I believe our NGL prices are about our realized prices in the 30 to 40% range, 40% range of the oil price based on our mix. So if we look at our realized NGL price was $41 or $42 or sorry, was it $47 a barrel in the first quarter. And let's see, our realized oil price was just around $100 a barrel. Our realized oil price was $82 a barrel in the first quarter Canadian, our realized oil price. Differentials were pretty high in that quarter.
So you're seeing a seeing a big improvement in the differentials, correct?
Correct. So that's about I think that's about 55%, sorry, of the 55 or 60% of the price of our realized oil price is our NGL price. Yes, and in differentials, to give you a picture, in the first quarter, differentials were about $19 US a barrel between WCS and WTI. And like I say, we've got about 2,200 barrels of that production in Medicine Hat and in Skiff. And the differentials have dropped to about $13 a barrel now. So that kind of $6 US difference is pretty significant for the
Yeah.
pricing here. On those two properties alone, that could represent $7 to $9 million a year of incremental cash flow.
Yeah. Well, I saw that. Okay. So the AECO natural gas price was $2.36 in the first quarter.
Yeah.
What was your realized gas price? And then are you seeing an uptick in the gas? We've seen a big spike in gas prices down here
It's
since the end
about
of April.
237 or so. So our
Okay.
price on average, very close to the
Okay.
average AECO price. We are not sadly seeing that uptick.
Okay.
In fact, our prices in the second quarter are lower than our prices in the first quarter. So we're going through, you know, like I say, 80% of our revenue is oil and liquids, which is great, but we're going through a world of hurt on natural gas. But another positive for next year is, so let's say like this year in our guidance, we're in the low twos for an average. If we just stopped right now, we'd probably be below that, but we're obviously thinking that prices are going to start to recover more towards the fourth quarter of this year. But given our guidance price, let's say our guidance says that, I believe I have, what is our guidance exactly for that right here? Our exact guidance is 225 Canadian per MCF. That's what's in our latest guidance. And so next year, we've already hedged a third of our gas production, and we've hedged that for 320 or 315 in MCF.
Good.
So we've already hedged our gas price at 30 to 40% higher than what we're realizing. And so that was from basically January 1st of next year all the way to December 31st, the full year. We've hedged a third of our gas price basically at you know, those higher prices. So
Yeah.
I believe that, you know, that could also be another $10 million revenue plus for us, 2025 versus 2024, if we could average $1 more on the price of gas.
Yeah, I will tell you down here, just in the last couple of weeks, the optimism for next year's gas price has significantly improved. We have three large LNG export facilities that are on time that should, over the next 9 months, should increase our export capacity by 6 or 7 BCF a day. And that totally wipes out the surplus. I mean, it looks like by this time next year, we could be looking at a deficit that demand for gas exceeds supply. And one of the reasons
why here off the West Coast too.
That helps too.
Same thing.
But our problem is we got, the same political problem you guys got up there. They block every freaking pipeline. So you got all this gas in the Permian, but you can't really produce any more of it because they're pipeline constrained. And there's pipeline constraints in Appalachia, and now there's dispute over a pipeline they're trying to build out of the Haynesville. So it's our government's our own worst enemy down here sometime. But I tell you, it's going to create a situation in the gas market that's pretty compelling for next year prices. Okay. One of the guys posted that he loves your power business. I do too. I think it's a great strategy. You're taking, gas production that you're basically for giving it away, and now you're going to wipe out your power cost, offset your power cost with this cash flow from the energy you're selling to the grid. So you're on those. You're really not using that power in those fields, are you? You're just putting all that power in the grid.
But let me give you, so we're kind of unique in that we've got a mixture of gas fields and a mixture of oil fields. So we have some areas where we have gas production where we can convert it to power and put it on the grid. And we have other areas where we have just oil production and maybe not a lot of solution gas. Okay. In Medhat, we can buy gas from the city of Medhat and put some power generation in Medhat. So that may be something that we want to do in the future to offset. We do have a field in Ante Creek where we do have some power generation in there, and we're not connected to the grid, and we generate our own power. So we have some of these infield projects to actually put some power in our fields. We'd like to try and reduce our operating costs in Cherry Hill and Matsawan by putting power in those two fields as well. So the combination of these things are, I mean, we're going to be using that to try and lower our operating costs in the future. Right now, we're just primarily focused on, hey, we've got these projects in front of us right now. Let's just get these things on, and then let's look at where we go from there and what's next. But our assets have been so starved for capital for so long that it's about time that, like, the reason we're still doing these power projects and not, you can't delay these things in Alberta because the regulatory process is such that once you get involved in a regulatory process to put something on the power grid that can take you 2 years to do, if you stop, or if you change the equipment, or if you change the scope, you go back to the start.
Yeah,
But
then
to
you gotta
give you
get
a
reapproved. Yeah.
picture of this, I mean, our power revenue, our power costs in 2020 were only $5 million a year when we first started this in Countess. Our power costs in 2022 were $23 million.
Gee.
So they went from 5 to 23 million. So, and last year they were about 20 million. If you analyze the fourth quarter, it was 14 million. What I'm saying is the volatility as we get more wind and as we get more solar on our grid, and we displace our coal with those two things, we're seeing tremendous volatility. So 1 month your power bill's 500,000, the next month it's 3 million. You have no way to plan.
I know. It's
What we're
crazy.
doing is we're going to have this offsetting revenue stream, which if we have this huge spike in our operating costs, we're going to have this huge spike in our power revenue, and it's going to be completely offsetting it. And it's really improving the sustainability of our company moving forward.
Yeah, I love it. I love that idea, and I hope more upstream companies do it, because that's going to be a problem. And you know, I said down here, you know, U.S. Voters, they complain about their gasoline bill. wait till their home electric bill and their home natural gas, you know, fuel bill fluctuates like crazy.
Yeah.
They're going to go crazy. It's going to be way more complaining than the gasoline price. Let's talk about the polymer flood. I'm very bullish personally on polymer floods. I had a big investment in Hemisphere that's had two very successful polymer floods in their Atlee Buffalo field. But I know Medicine Hat, can you go back to the slide or something? Tell us, how big is that? How much oil in place? What's the polymer flood potential there?
Yeah, Med Hat is significantly larger oil in place wise than maybe the Hemisphere fields. In fact,
Yeah, I'm sure
I think if you add up both the Hemisphere fields, Med Hat is 4 times bigger. So in terms of oil in place, so it's got 300 million barrels of oil in place. It may have up to 350 because we've mapped regions of oil that, you know, haven't been fully drilled up yet. But of the developed oil in place, it's about 300 million barrels. If you look at those purple boxes on this chart, those are boxes that have been polymer flooded. That represents about 70 million of that 300 million barrels. So about 25% or 20 to 25% of the field's been flooded. In that, we're forecasting about 8% incremental recovery of that oil that's been flooded. There's some orange boxes on that chart, and those are just the starting boxes, but this is where we're moving that polymer flood to this year. So we're expanding the polymer flood to include those boxes.
Okay.
Ultimately, I feel that we'll probably expand the polymer flood to cover about another 150 million barrels of oil. Like, we won't be flooding probably the whole field over time, but we have the blending facilities here. They're already built. The capital's already spent. The idea here is that you just convert water injectors to polymer injectors over time as it makes sense. And then later on, you convert those same injectors back to water. So if we flooded 150 million barrels of incremental oil in place in this field, that would add about 10 million barrels of recoverable reserves. 0 of that is booked in the reserve report. None of that is in there. That is all upside. That's not in anything. The only thing that's in here is a little bit more polymer over the next 4 or 5 years on the existing patterns, and then the development wedge of the drilling of the 30 wells. And that alone is worth over $60 million or close to $1 a share. And that alone adds about 5 million barrels. But that's primarily all drilling. So really there is a huge upside in here, which is not booked or not captured in our reserves or in any of the numbers I gave you to continue to expand this polymer throughout this field.
So, well, this is one of the main reasons you have such a low decline rate, correct?
Absolutely.
Okay.
Even with the existing drilling, we can keep this field flat to well beyond 2030. And we have a lot of fields like this. Part of the reason we have such a low decline rate is because we haven't spent any money on these assets. I mean, if you look at our history, you know, with your bank line going from $200 million down to zero, essentially. And then we exited 2020 with about 90 million of debt, but all that debt was due to Aimco. And by the end of this year, we'll have paid all that. End of this year or the first quarter next year, we'll have paid all that debt back. So if you're paying and paying and paying debt down, and you're, you know, you've got kind of lower commodity prices, you're basically not sustaining your business by drilling and doing all of the things that you should be doing to grow this. So, I mean, you're getting higher operating costs. You're in this kind of death spiral. So at the end of the day, when I start to look at next year and I start to look at how much money we're going to put in the ground, we're going to be putting this money into existing fields. Other than the stuff we're doing in the Duvernay, all the rest of it is going to be in these existing fields, and it's going to come on at very low incremental operating costs. And it's going to generate tremendous cash flow, and it's going to dramatically improve the company moving forward.
Because this field, the way it's developed, you already have all the production facilities in place, right?
Everything is already in place.
It's already in place. So you're just adding more to existing
Yeah,
facilities.
so
Now,
these wells that we drilled, the green wedge on that chart, those 8 wells, those all came on essentially to existing facilities. 2 of those wells are this year and ultimately 3 are going to be converted to water injectors. So,
okay.
you know, you drill one well, then you drill another well next to it, and then you convert this middle well to a water injector. And that's the way that's why you get longer life in these things. So
Yeah.
a lot of the projects that we've got this year in Matzo and in Mad Hat are water flood projects, which means we're actually converting 5 or 6 wells. We're actually stopping producing these wells and we're converting them to water injectors. So we're losing production this year. But next year, that production is going to be higher, and the year after, it's going to be higher. And you're basically contributing to your low future decline by investing in these pools with secondary recovery.
Well, when you say that, you know, your cash flow this year could be like $70 million and could go to 85 or 95 next year, is that with the same level of production?
Same level of production. And if we spend the kind of money that we could spend next year, production will be higher for sure. Because it costs us about 30 million to maintain our production in a given year. And what I said is that kind of free cash flow is going to go from like 16 million to over 50. So some of that's going to be in the Duvernay. A lot of that is relative to the timing and the phasing. We may drill, you know, 6 to 8 Duvernay wells next year at arguably around 35% working interest. And if we were to do that, I mean, I can see our exit rate being north of 13,000 barrels a day at the end of next year.
Okay. So if I model this thing and I assume, you know, 10% annual production growth, fully funded by free cash flow, that'd be pretty conservative, you'd say?
I think exit to exit, that's an easy one.
Okay.
On average for the year, I'd say it's close to being right on. Exit to exit, it's probably really conservative. It's probably it's probably higher than that exit to exit, and higher than that moving into the future years.
Yeah. Okay. Yeah, because you really don't. Now, go to the Duvernay thing. Go to that joint venture. So are they? How much what's the cost of those wells? And yeah, and then you got a lot of locations there. That's for damn sure.
Yeah.
How long are those laterals, by the way?
Okay, so these laterals are in the neighborhood. They're 2 miles long.
Oh wow. Okay.
And we're drilling them azimuthally, diagonally, which basically sets up the fracks to go kind of southeast, or sorry, northeast to southwest, and and essentially these wells are probably going to have about 60 fracture stimulations in each of them. Those fracture stimulations are going to be on the order of 100 tons each. It's going to be 1.5 to 2 tons per meter of sand put in place. Very similar completion program, maybe slightly different fluids and slightly lower cost, but similar completion program to the ones that those 3 wells have right there. So the idea is, hey, you've already done it 3 times on your land. If I go back one slide, you will start to see in blue some of the offsetting drilling. The drilling to the south, those diagonal horizontals or azimuthal horizontals are drilled by Paramount. They were drilled by Paramount, Crescent Point, and Repsol, but Paramount's got them all now. And those wells to the north, especially the vertical ones, north and south, were drilled primarily by Baytex. And so Baytex has drilled almost 30 wells into the play directly to the north of us. Paramount has drilled a similar number to the south of us. So you've got, 40 to 60 wells already in the play on production. From those wells where the sweet spot is. We're right in the heart of it. We've got 3 wells that are already drilled. We're not asking for more than what we've already produced in these 3 wells. So we're basically just saying, let's forecast out these 3 wells and let's see what that looks like if we put 11 to 13 million dollars. That we're using 11 at the low end and 13 at the high end for capital. As we start to drill these wells on 3 to 6 well pads, and as we start to put more infrastructure in place on the water side, we're going to drive those costs lower. But these are just initial costs for now, for the next year and a half. And the beauty of this play is, if you really look at it, let's say we spend 30 million gross to drill 2 wells, or 25 million gross to drill 2 wells this year. We drill 6 to 8 wells, we spend close to 100 million next year and 100 million the year after. Then by 2027, this should largely become self-funding. The cash flow coming off the wells that we've already drilled will fund the future development, unless we want to ramp up that development more and more and more and put more cash in and accelerate the production. But the beauty of it is, it should be largely a self-funding play. It should be able to grow on its own. So when you look at Journey with very low debt, once this play becomes self-funding, then that becomes the time to look at, either, buybacks or dividends, or returning capital to shareholders, kind of the 2027 timeframe.
How did you come up with the splits on that joint venture? And are future costs just straight up?
Yes. So essentially what we said is, we don't want to sell you our interests. We don't want to farm out our land. A lot of the land of the joint venture, when we originally accumulated and these 3 wells were drilled, a lot of that land expired, and it wasn't drilled in time to be maintained. And so we went out there last year, and right in the heart of this play, we accumulated about 34 net sections of land. And we knew that it was really good quality land. In fact, to the south of us, about 30 sections of land were sold in the March 20th land sale. If you look at Baytex's first quarter release, you'll see that they were the ones who bought it. They paid $1 million a section for those. So if we look at 34 sections and $1 million each, right there, that's about 50 cents a share in value. But we didn't want to get that value. We could have farmed it out, and then we could have been drilling, 20% wells moving forward. They could have carried us on 2 or 3 wells. They might have, so we would have had some great value out of the chute, but the maximum upside that would have been worth would have been about 70 or 75 million net to Journey once it was fully developed. By doing it the way we did it, this can be worth hundreds of millions to Journey moving forward, because we said, look, our balance sheet is in good shape. Now with this convertible debenture, we have the money to fund our business on our own. We could drill these at 100%, but we don't want to. But we don't want to lose any locations. We don't want to lose any upside, but we want to pay our own share. I look at this and say, hey, I'd rather drill 6 wells at 30% interest than 2 wells at 100% interest, just because as a small company, Journey doesn't want to be exposed to, 10 or $11 million wells on its own. We would
Right.
rather be exposed to a $4 million expenditure that can have an outcome, and we would rather do 3 $4 million expenditures than one $12 million expenditure.
Right.
So we said, Spartan, you have this land, you want into our play. We know we've got good land. We know you've got good land in and around us. Why don't we just combine our land with your land and doing on a working interest, doing on a net acre basis, so that the net acres all work out. And you can do it. You can do it any way you want, but that's the way it came to pass.
On that southern part there, where it's kind of checkerboarded.
Yeah.
Can you guys sit down with Baytex and kind of work out a joint development plan there?
Well,
down
that's part of the plan, and so the way we've set this up is we're at 37.5% interest now. That's the way the land works out. But if Spartan Delta were able to accumulate some additional lands and contribute them to the joint venture at their cost, then we would be willing to ratchet down our working interest to a low point of 30%. So if they fill in all of those white spaces that are missing on that map sheet, then they can basically drive their working interest up to 70% from 62.5, which would drive ours down to 30% from 37.
Or are you saying, okay, so the stuff inside the blue dash line, those white boxes are open? Those white sections are open?
They're controlled by others, and
Okay.
we're actively pursuing them, both
But
as
Baytex is
joint
below that,
companies
then
and
you're
Spartan on
yeah.
their own.
Okay, so you're saying Baytex is to the south of that.
Baytex owns some of those.
Oh,
Some
okay.
of those are owned by other freeholders like Canpar. I'll tell you, we've already got about 6 or 7 of those sections sewn up.
Okay, good. Okay, so you're gonna fill in some more of that.
You bet.
Okay,
We're gonna fill in the blanks over time.
okay, good. Yeah, I'm telling you, that's a big time play. It looks really good. So,
Well, we feel really confident in the play. We've been giant believers in this play over a really long period of time.
yeah, good. All right, man. Okay, let me see if
The
I got
other thing
everything.
that I didn't highlight that I'll just highlight just before we leave this, Dan, if I can,
Okay.
is that red gas plant inside that red box, that red gas plant, that's ours. That's
Oh, okay.
That's our Gilby plant. That's where the power project is being built. So the
Oh, okay.
solution gas for this will actually feed that power project over time. And all those black pipelines on there, those are our lines.
Oh,
So we
great.
already have the gas infrastructure and the plant and the power plant there for the solution gas for these wells. I know it's 75% oil and light oil as that, but there is still some gas component to this, and we're going to be using that gas to generate power, and we're going to be gathering that gas through our own infrastructure.
Oh, that's outstanding. Okay. Okay, let's see. Oh, on the convertible debt, how many shares did that convert into, and what's the time limit on it?
Yeah, so basically it's $38 million in convertible debentures. The deal closed on March 20th, 2024. So that basically it's a 5-year term. So that's March of 2029. That's why I say the debt's turned out to 2029.
Okay.
Essentially that converts at $5 a share. So 38 over 5, that's 7.6 million shares of Journey. The conditions on which it would convert, well, I mean, obviously it'll convert if Journey's trading above $5 a share when we go to redeem that.
Right.
But if Journey trades at more than $6.25 a share, we can force an early conversion after 3 years. So by 2027, March of 2027, if the stock was trading above 6.25, we could easily convert that to shares. And when I look at it, by the end of this year, maybe not the end of this year, but when those power projects are on and those add to our PDP value, our PDP value should be very close to that $6 a share. So I can see the stock trading above 6.25 a share sometime in the next 2 to 3 years, and I can see us early converting those to equity.
Good. And I think, going back to the multiple you guys are trading for, I can give you like 5 or 6 really strong companies in our model portfolios that are trading below book value, which there's no explanation for. And the only thing I can think of is just the volatility of the oil market and so much belief out there that, investors don't have confidence in the oil price or something. Anyway.
It's tough for smaller companies like ours to get on the radar screen, and we've got some things that'll differentiate us. And the more people that look at it,
Yeah.
the more exciting it'll be. The problem with it is it's still fairly small. So to
Yeah.
get on the radar screen of some of these larger companies, it really needs to be a bit bigger. So as we start spending more and more money on the Duvernay, and as these power projects come on, and as we continue to do more acquisitions, I mean, I don't want to take away from our ability to do these acquisitions. You saw how creative we were to doing that acquisition and how we creatively financed it. I still believe that when you're in an environment where prices are increasing over time, and I think the environment changed. So from 2014 to 2021, I think we're in an environment where every year prices slowly decreased. I think since the start of 2021 to now, prices have been the same or increasing year over year. So if you're in that environment where prices are growing, you want to be the guy with the most barrels under management possible. So I believe that you want to have a big, stable, lots of PDP reserves as a base. And once that, every year, not only will we get credit for the value that we're adding through our drilling program, but we'll get credit for the expanding value of our base as prices go up. So I believe that we have the perfect positioning for commodity prices to stay the same or go up a little bit over the next 3 to 5 years, go back to where they were in 2014. And you've got a company that is significantly undervalued if the prices stay the same. If they go up, it's ridiculous.
Yeah, and I did M&A work for Hess for 3 years, and I had about 7 MBAs with me. We were looking at public companies for takeover targets, and I could tell you, if we found good companies that had a lot of acreage held by production, like you guys, you have a lot of what I call running room, that adds to their value. And if we could buy those things for 6 times cash flow, they were on our buy list.
Those were the good days, weren't they?
Yeah, those were the days. But I mean, now you got companies trading for 2, 3 times operating cash flow that have just hundreds and hundreds of low risk development drilling locations. My goodness, why
it's
not?
because the energy space is largely out of favor, and that won't stay there forever.
Yeah, well, it's a one question. Bill says, will windmills and solar panels replace coal and natural gas? The answer is no. The windmills are a total disaster at this point, and because of high interest costs, all the windmill projects are being canceled. Because there's so much upfront cost, and then the wind doesn't blow all the time. Solar makes some sense. I can understand that. Maybe solar panel costs are coming down, but they're just not going to replace coal and natural gas. There's one question. It says from John. He says, explain the pricing train to get to 225 per MCF equivalent for the power conversion. Does that make sense to you?
The pricing train to get to 225 per MCF equivalent.
Oh no, you said you were selling. It's basically
it's like $9.
Yeah, $9. I'm sorry, $9.25. What you're saying is you're taking your gas and converting that gas to as if you would be selling it for $9.25.
Yeah, that's right. So
the
if
price
we look
you're getting
at
for the power,
and that was a stat. That was just an actual stat for the 9 months, the start of 2023. Now, power prices have been volatile. They come down, they go up. So if you look at the power, the first 9 months, 2023, and basically in our Countess project, we sold basically 1 million a day of gas because that's what we burned to generate the power for $9.70 an MCF. And
yeah, that's awesome.
and the previous year was like $11 an MCF. And it may go down in future years. I mean, it's going to be up and down, but the beauty of what we're doing here is that these projects can be turned on and turned off daily, weekly, whatever you want, because they're reciprocating power. We don't need the sun to shine or the wind to blow. So if you've got rising carbon prices, we've got a carbon tax here in Canada, it's fairly significant. It's forecast to grow. When I talk about the $90 million of PV value that these projects are, that includes carbon taxes escalating from the current level of $85 a ton to $170 a ton by 2030, and then escalating from there. It also includes increasing gas prices because the reserve reports have extremely robust gas price forecasts into the future, and it includes relatively flat power prices. So if you look at it, in my view, there's huge upside in that $90 million if the carbon tax got reduced or eliminated, or if the price of natural gas didn't go up as much, or if power prices were just higher.
Yeah.
And I think that there's huge upside also in the fact that the volatility is such that we may be able to produce these things for half the year, but get 90% of the revenue
Yeah.
and
Hey,
not pay the taxes.
and these power plants, they're long life assets, correct?
Yeah, they're 20 years.
They're 20 years, and they have very little maintenance capital once they're built, correct?
Yeah, and that maintenance capital is all in that 90 million. We put in maintenance capital for these things. We put in overhauls and turnarounds and the existing maintenance capital and the gas price. Everything's in there.
Yeah, I mean, those are valuable assets. I mean, there's, if you had to, I guess you could sell those, just sell them out, but you're not going to do that.
Yeah, well, I think you could. I think you got to, like, to me, you're not going to get the full value realization until they're on and they've been on for a little bit. And when people see
Right.
what they're doing and the people can forecast off of that, then you're going to get your higher value if you wanted to sell.
Yeah. Okay. Just a couple more questions. Do we answer? Somebody asked, are the slides going to be available? Well, okay, we recorded this just as you've seen it today, and it'll go out, and so you'll have all the things we've shown on the slides in the replay. So that'll go out to all of our members this afternoon. Now, there's only 29, 30 people on this call, but our replay link is going to go out to 500 or 600 people. And most of our members do watch these when they have time.
100% of these slides are also on our corporate website.
Yeah, and you can just download the slides from their website, correct? Then as somebody asks, is all the dollars we've been talking about in Canadian dollars? I think other than the WTI price and the US gas price or something, I think everything else is in Canadian dollars, correct?
Thank you so much, Dan, because that's something I forget to say.
Yeah, I know.
And yes, everything is in Canadian. Every price that I've given you is in Canadian dollars, except when I talk about WTI. And that's,
yeah. And just one more point I want to add. Journey has got a large amount of tax pool that's going to cover their current income taxes for many years.
yes.
For at least 2 or 3 more years, right?
Oh, more than that, probably.
More than that. And then you're
years.
going to continue to do more drilling, and that's going to create more deductions
Correct.
and everything. That is extremely important to when I value one of these small caps like this, and they're not having to pay 20% to the government, you know, at the back end on income taxes. That's extremely important to my operating cash flow and free cash flow calculations, which is how I value the company. So that's just something else to keep in consideration. So, but anyway, Alex, man, good presentation. I'm excited about it. I'm gonna spend some time on. I've got about 10 things I need to update here on the other companies, but sometime by the end of this month or something, we'll be publishing a profile on the company. I will probably be adding it to our small cap growth portfolio. We have 3 model portfolios in our newsletter, and this one is a good fit for our small cap growth portfolio. And anyway, thanks again. And maybe sometime you can get down to Houston, do a luncheon for us in the fall or something, because I know you our guys
we'll make a
really
trip for that. Sure.
Okay. All right.
Thank you so much.
Yeah, thank you so much. And Sabrina, why don't you end it there and just send me the replay link.